Yes, sir.
Good afternoon to everybody. Professor Sahadevan, my colleagues and students. We are quite fortunate today that we have an eminent speaker, Professor Sahadevan, with us today here. He was a student of Cochin University for 1 year. After completing his master's degree, he came to Cochin University for his MPhil. After completing MPhil, he moved to Hyderabad Central University, where he completed his PhD. And when the PhD viva was going on, the examiners were so much impressed with his work that they offered him a job then and there in the Institute of Capital Studies at Bombay or Mumbai. From there, he moved to IIM Lucknow and rose up in the ladder. Now he is one of the senior most professors there, and he was the dean of the School of Social Science or faculty, whatever it may be. He was dean for a long time. And now he is a very busy person, and he is preoccupied with a lot of teaching, research, consultancy, and whatnot. And despite this busy schedule, he has been able to squeeze in some time for us. And we are thankful to Professor Sahadevan for that. He has published a lot on various aspects of economic development in the country. And I accord a very warm welcome to Sahadevan. Now I request Sahadevan to address our student on the topic on bank rate and policy related issues. Thank you. Sahadevan, please.
Thank you very much, sir. It's rather an honor to be with all of you today, joining my alma mater for a brief lecture. Right. Thank you very much for extending this invitation to me. In fact, as you rightly pointed it out, that this is a very busy time for all of us in IIMs, because the academic year has just closed by 31st March, and we are all very busy with evaluation, grading, and so many other activities post-examination. A lot of other MDPs are also going on, and I am also thickly involved in a lot of administrative matters as well. But then I couldn't say no to when you requested me to give a lecture. I wholeheartedly accepted your invitation, and that's why I'm here today. So thank you very much. Of course, I'm not very sure, what will be appreciated in terms of the topic and the depth of the topic. I have chosen a topic on my own. Since MK sir has requested me, I thought it will be better to choose something which is very closely related to financial technologies or the financial sector in general, right? That is why I have taken this particular topic, which is about the RBI's policy stance, right? I'm sure this is of lot of current relevance to all of us. There are two important things which you must know before we start proceeding with the discussion. I will make it more participative rather than kind of a monologue. You are all very free to interrupt me at any point in time. We will make it more of a interactive session, right? And there are two important developments in the light of that, I am presenting this particular topic, which is very, very simple and not much technical aspects about it, right? I will try to keep it as simple as possible and without losing the importance of the policy relevance of this particular issue. Right? So the two developments which have taken place recently, in the light of which I am presenting my PowerPoint presentation, they are: point number one, the recent monetary policy announcement by the Reserve Bank of India. You all know, which came out on 8th of April. I think just a couple of weeks before. Point number two, the global developments today and the policy stance which was taken by various central banks like the Federal Reserve in the US and the European Central Bank and many other individual country central banks, how they have tried to address the current burning issue of inflation. You all know about this. In the US today, the inflation rate has crossed the historically high, right? It touched almost 8.7%, right? The highest in the last 40 years. This actually, a very burning issue in the US. So is the case with the European, area. You can say European bloc or Euro area, where the inflation rate has almost crossed 5.7%, right? This was quite unprecedented. But then you must understand the central bank has, taken up this issue at the right earnest, and the solution has been worked out, is being worked out. In the US, you have probably heard about the central bank, the Federal Reserve has already increased the interest rate, right? And also planning for the second hike within few days, almost by 50 basis points. And the position of the European Central Bank is not different either, right? So most of the world countries today are actually facing, very high inflation. US, Euro area, Turkey, you must have heard about, almost the inflation rate crossed 60%, right? The only one country today which is, probably, comfortable in terms of reasonable rate of inflation is Japan, because Japan has been, under very serious deflationary trend almost for 2.5 decades, and right now they are actually, facing a slightly higher inflation, which is what they wanted. Their inflation target has been 2% for so many years, but they never touched 2%. But they are so happy today, the Japanese economy and the policy makers, right? Why? Because inflation is moving upward, right? Otherwise, practically all countries, including our own, are actually facing the threat of very high inflation. In India, you have seen, though we have the so-called FIT, the flexible inflation target, which is for plus or minus 2%, right? Reserve Bank is trying hard to be within that range. It's almost crossed 6% in February 2022, right? Now Reserve Bank has to put everything in order to control this, growing inflation, right? We will examine this policy issue, right, in the light of the latest monetary policy announcement by the Reserve Bank of India, precisely which took place on 8th of February 2022, right? I have two, objectives here. One, I'm sure you are very familiar with the monetary policy and various tools, by which the Reserve Bank is controlling money supply, not only for the long term, even for the short to medium term. You have heard about repo rate, reverse repo rate, marginal standing facility, and the the latest one which Reserve Bank has introduced is known as the standing deposit facility, right? In addition to variable rate of repo or variable rate repo, or you also have variable rate reverse repo, right? So there are various tools, by which the Reserve Bank of India is trying to control, short-term liquidity and interest rate. That is very, very important for us. Right now, let me, share before I, go into the details of the presentation, right? So the objective is not just to explain, the whole mechanics of inflation control and credit control and short-term interest rate, but also, try to understand whether there is a complete, synchronization of the policy stance vis-a-vis the ground reality in our country. That is more important, right? The question which I am raising here is, have Reserve Bank of India done adequate enough to control inflation today? Or they are deviating from the so-called fiduciary responsibility of the bank as far as inflation control is concerned. There is a clear mandate for the Reserve Bank of India. I'm sure you know about all this, right? Reserve Bank is essentially to control, the prime responsibility of the RBI is to control, inflation, right? Therefore, it will not hamper the growth of our country, right? But we have to examine this of late, the so-called accommodating stance of the monetary policy. Reserve Bank has been accommodating the government's requirement or interest of the government, right? In that process, Reserve Bank is, continuing to be, muted as far as the inflation is concerned. It has crossed almost 4% many months before, right? Reserve Bank has been still waiting, even when it has crossed the 6% in February 2022. Reserve Bank is still continuing with the so-called, accommodating stance. There we have to, understand why it is so, right? Is Reserve Bank of India is harming the economy's growth or trying to boost the growth in the economy? What is going to happen? This is what I am trying to, flag. This is an important issue which I am flagging very prominently before this August audience, right? I hope you understand what I am trying to explain to you, right? Am I right?
Yes, sir.
Yes,
Okay.
we can proceed now.
Let me now start sharing my screen. Is this very visible to you?
Yes, it is visible.
It
No
is.
problem.
I am also very much audible to you, right? Can I continue?
Okay,
Yeah.
you can continue.
Okay. So the title which I have proposed to Professor MKS is this, that the short-term liquidity and interest rate management is a revision of policy stance overdue. I said this is in the context of, or in the light of, the latest bi-monthly monetary policy announcement by the Reserve Bank of India on 8th of April 2022. Right? And taking this forward, I'm sure you are very familiar with this mandate to the Reserve Bank of India as defined by the RBI Act 1934. I have underlined that particular point. The utmost priority, right, the objective of monetary policy or the very existence of Reserve Bank of India is essentially to maintain price stability. Right? That is the objective of monetary policy, while keeping in mind the objective of growth. Overall growth is also important, but the most important thing which RBI is expected is what is in terms of price stability, right? Ensuring price stability, which has been defined now. Today you are familiar with that there is a kind of an inflation targeting that is supposed to increase the credibility of the Reserve Bank of India as far as the inflation control is concerned. Reserve Bank has maintained inflation target of 4 plus or minus 2%. That means the lowest possible inflation rate is 2%, right? And the maximum tolerance to inflation is defined to be 6%. So on an average, the Reserve Bank of India would try to achieve this target at any given point in time, right? But there are exceptions where the target has been broken, right? This floor has been not only floor, the ceiling as well, right? The ceiling has been broken. For example, in the last February, this 2022 February, the inflation rate has crossed 6.1%, which is just above the ceiling of the inflation target, the so-called FIT, flexible inflation target. Reserve Bank says doesn't matter because we are looking at an annual average of 6%. Therefore, in the previous quarters and months, our inflation rate has been hovering around 5 plus percent. Therefore, on an average, we expected to reach somewhere around 5.7 in the financial year ending by 31st March 2022, right? But then there are concerns that where are we heading for? Why we have not acted enough to control inflation? How long we can continue with this kind of an accommodating policy stance? Will that harm the people in the country, or it is already harmed the people, right? Because the RBI has a kind of a fear that they say one of the MPC members, Mridul Sagar, is the Deputy Governor of Reserve Bank of India, who is also a member of the Monetary Policy Committee. He, after the meeting, he made a statement that in India the Phillips curve is flatter. I'm sure you students particularly would have studied the Phillips curve. He thereby means that there is a cost of inflation control, right? If you try to reduce the inflation, the unemployment rate is going to go up significantly, right? Because there is a trade-off. In the short run, there is a visible trade-off. So he says, if the interest rate goes up, that can actually hamper production in our country and output in our country. That can actually trigger much larger, decline in GDP in the medium to long run. So therefore, this fear is actually, prevailing very powerfully in the RBI circle. The reason why RBI is keeping quiet or continuing with the so-called the accommodating stance as far as the monetary policy is concerned. I'm sure you know about this, right? And you are aware that look at the recent history of the policy rates, particularly the repo rate, which has been there as 4%, almost for the last 22 months. The rate has not changed, but inflation has been moving upward, and there is too much liquidity in the marketplace today. I will show you the data as far as the liquidity is concerned. Excessive liquidity in the marketplace, which is actually making all these policy rates, the repo, reverse repo, marginal standing facility, and now the standing deposit facility, all these rates are almost redundant, right? When you have too much liquidity in the market, you cannot expect that the repo rate is going to be the benchmark short-term interest rate. It is very difficult. You have a parallel call money market in our country where the rates have been actually much lower. The call money rate has actually breached the floor of the interest rate corridor, right? I will explain the concept of interest rate corridor, right? The corridor, which is defined by the upper ceiling of the corridor, is defined by the repo rate, and the floor of the corridor is defined by the reverse repo rate. Reverse repo rate has been 3.35, right? In a normal course, we don't expect, that the reverse repo rate, the call money rate, falling below the reverse repo rate, but it has been happening. I mean, not occasionally, it has been continuously happening that the call money rate, that means the interbank lending and borrowing rate in our country, has been much lower than that of the floor of the corridor, which is defined by the reverse repo rate. I will show you the data. I am asking in this particular context, the main question which I am asking is, is a policy revision overdue in our country? Yes, it is overdue. The Reserve Bank has to, put its acts together to control the liquidity and control the inflation now. Otherwise, that can lead to many macroeconomic imbalances in the medium to long term. It may happen, right? There is the fear. This is what is the fear prevailing not only within the Reserve Bank of India, even many of us. Probably government would be happy because there is so much liquidity, right? It might promote growth, but how long we can wait? How long we can allow the liquidity to be there for? I mean, it's almost so many months now. So Reserve Bank probably should find it the right time now to, suck the liquidity, right? To jack up the interest rate and, control the inflation rate. Otherwise, it might hamper growth in the medium to long term. This is what the main point, right? I mean, now let me, if you don't have any particular question regarding this, I will take things forward. I am sure you know about this, right? Monetary policy and various tools available with the Reserve Bank of India to control liquidity and interest rate. Particularly, I'm going to talk about this particular issue. Let me highlight that particular point: standing deposit facility, right? The so-called interest rate corridor, the short-term interest rate corridor. Reserve Bank wanted to create the repo rate as the benchmark rate in the short-term funds market, right? Whether it is able to achieve that objective is, it's a different question. We will examine that, right? And taking things forward, look at this. I assume that you are familiar with these terms and terminologies. The instruments for liquidity adjustment facility is called LAF, right? Point number one, the liquidity adjustment facility. The LAF consists of overnight repo and reverse repo, as well as term repo, which is called VRR. This is variable rate repo, or you have variable rate reverse repo as well, right? This is what the rate, as of 8th April 2022, by the latest bi-monthly monetary policy announcement, Reserve Bank of India has maintained 4% repo rate. Right, that means at 4%, the Reserve Bank of India lent liquidity to the banking system, right? And there is reverse repo as well. Reverse repo now, Reserve Bank says we are, ready to absorb liquidity. If the commercial banks have surplus liquidity at any given point in time, they can park that liquidity with the Reserve Bank of India at a reverse repo rate, which is 3.35%, right? But the most important development today in the latest monetary policy announcement is this, that, now the Reserve Bank of India has intentionally made this reverse repo redundant by coming out with a new rate, which is called, standing deposit facility. That is what is the third point, right? Now the commercial banks having surplus liquidity, there is surplus liquidity. You can, see in your own eyes, particularly in the latest, the data released by the government itself, Reserve Bank itself says that, bank deposits have gone up, substantially, right? And you can also see in terms of the oversubscription for the IPOs. That is one very significant factor, right? Practically any IPO, whether it is good or bad or worthy enough or not, all those IPOs are extensively oversubscribed in the market. That essentially means people have enormous amount of surplus money. Financial institutions have enormous amount of money. They are also looking out for credit-worthy investors for lending, and also various productive investments, isn't it? That is what is shown now. Therefore, the Reserve Bank of India has come out with an alternative kind of corridor, right? That corridor, now the floor has been lifted. Initially, the floor of the corridor was defined by the reverse repo, which is 3.35%. Now it has been increased to 3.75%. So if you look from the bottom, the corridor has become narrower, right? Between the repo and the standing facility, deposit facility is only 25 basis points. Earlier, the margin between repo and reverse repo has been almost 65%. 4% is the repo and 3.35% has been the reverse repo, leaving a margin of 65 basis points. Now Reserve Bank says, no problem. If you have surplus money, you keep with us, right? We will give you, 3.75% rate return, right? So banks can overnight lend to Reserve Bank of India or park their funds with the Reserve Bank of India at 3.75%, right? And on the other side, look at the ceiling of the floor, right? Originally, the ceiling of the interest rate corridor has been repo, which is 4%, and subsequently, I think almost maybe around roughly around 10 years before, Reserve Bank has come out with the so-called marginal standing facility. It's called MSF. That is the penal rate. That essentially means, banks, those who need money, short-term liquidity, overnight liquidity, they can borrow at the MSF, which is 4.25% today. That means the corridor has got widened today. From the bottom, it is going up, right? From the reverse repo 3.35 to standing deposit facility at 3.75, but from the ceiling, right now the ceiling has gone up. Ceiling has gone up from 4% repo to almost 4.25% marginal standing facility. That is what I am trying to explain to you from here. Of course, this is also known to you. In the short-term liquidity adjustment facility, there are two alternative channels or mechanisms through which the adequate liquidity is made available, right? One, through the RBI sponsored repo and reverse repo window, right? That is, you can see that at the center we have the Reserve Bank of India. Reserve Bank lends and borrows from the scheduled commercial bank. You have Bank A, B, C, and so on to Bank N. They are the participants in the repo and reverse repo, which is conducted by the Reserve Bank of India. Reserve Bank lends money, right? Short-term overnight liquidity to the banks and financial institutions, right? And the Reserve Bank also absorb liquidity, from the money market, short-term money at the reverse repo, isn't it? This is what is the repo and reverse repo window. You also must understand, conventionally in India, there has been a very vibrant money market, right? Prior to the repo market came up in 1997, conventionally we were having a, some sort of a interbank call money market, very popularly known as interbank call money market. Banks among themselves, there is no role here for the Reserve Bank of India. This is actually conducted by, right, the commercial banks, right? Commercial banks will borrow among themselves. Commercial banks also will lend among themselves, borrowing and lending within the commercial banks. This market used to be very, very vibrant, but at the same time used to be very highly volatile. Right? So that created a lot of problems in the economy. When the short-term interest rate is becoming very highly volatile, for example, in the money market, short-term money market, call money market, the rate used to go up to almost 100% sometimes, depending on the CRR requirement of the banks. Particularly on Fridays, the rule has been this, that on every Friday, by close of business by 5:30 p.m., every bank should show in their book of accounts the minimum required CRR, right? Therefore, every Friday, whichever banks do not meet that requirement would actually borrow from the market. So every Friday, the rate used to peak. You can see very highly volatile rate, and the rate peaking on every Friday in the evening. So it used to be a kind of a very unstable short-term funds market in our country. That is why Reserve Bank of India came out with a very structured window in the form of repo and reverse repo. Now you can make out, maybe currently this is an exception, the current situation. Otherwise, in general, for the last so many years, you can see, you can also examine with the data that the repo rate has become the benchmark short-term interest rate, right? Very effective benchmark rate, right? So the money market in our country, short-term fund market in our country has become very, very stable because of the introduction of repo and reverse repo window in our country, right? Unlike the earlier practice wherein the interbank call money rate, right, the so-called call money rate used to be very highly volatile. I am sure you know about this alternative market where funds are available. Now I will take you to this. Are you with me so far?
Yes, sir.
I am
Yes,
not sure about your understanding and your, the curriculum and what all has gone into that, what all you have already studied, right? This is just a testing the water. As I said before, when Professor MKS requested me, I be his student, I immediately accepted. I will identify a topic and I would convey that to you, right? I thought this may be of interest to you today, right? The interest rate, the short-term interest rate in our country, right? Which matters, right? Which matters? The liquidity, surplus or deficit in the money market, that can drive the interest rate and inflation, right? High inflation can lead to various macroeconomic imbalances in our country, and short-term interest rate can also drive the long-term interest rate, which can in turn cause growth related problems in our country. That is why this topic is important as far as I am concerned. I hope you are with me on this. Shall I go forward? Professor MKS?
You can.
Sir?
You can.
Okay. So now let me straight take you to the liquidity adjustment facility, which is called LAF, and interest rate corridor. Corridor I have already explained. This is a very kacha drawing. I mean, very raw kind of drawing. Very quickly I put certain points together just to make things clearer to all of you, right? The marginal standing facility rate and the reverse repo rate determine the corridor for the daily movement in the weighted average call money. Now you understand this is the conventional the so-called corridor, right? This particular black line and this blue line at the bottom. This is the original corridor, right? This original corridor is defined by the ceiling of the corridor is defined by the repo rate, which is 4%. I said this has been there for the last 22 months. Reserve Bank has not touched this particular rate, right? And it continued to vary the reverse repo rate, right? As of today, the reverse repo rate is 3.35%. So the conventional, the original corridor is defined by these two, right? Now you can find the movement in the short term. The interest rate cannot move beyond or below the corridor. It cannot go beyond, for example, the call money rate. I can probably compare this with a snake in a tunnel. This is like a snake in a tunnel. The snake, which is interest rate, cannot cross the ceiling repo rate. Why should any particular bank borrow from call money market when RBI is offering 4% return for overnight loans, right? Reserve Bank says, I am ready here. I can give you certain amount of liquidity to you at 4% interest. Suppose I am the Canara Bank. Why should I borrow from the interbank market when Reserve Bank of India is offering me funds at 4% interest rate? That means the ceiling of the corridor is fixed, isn't it? Why should the snake cross this corridor? There is no reason why it should happen, right? Similarly, you can understand this blue line here at the bottom. This is the floor of the corridor. What does that essentially mean? This is nothing but the reverse repo rate, right? When the Reserve Bank, why should I lend in the call money market? I am the Canara Bank or State Bank of India. Why should I lend to the interbank market when Reserve Bank of India is offering me 3.35% return on my overnight? I would rather park with the Reserve Bank of India at 3.35%. And if I need liquidity, I would borrow from Reserve Bank of India at the repo rate. Therefore, the tunnel is fixed. I mean, the width of the corridor, right? Width of the corridor, therefore, is defined by 4% by repo, and the 3.35% is nothing but the reverse repo. So the margin is almost 65 basis point, isn't it? This is what the interest rate corridor concerns. So this has effectively, put control, or, very effectively control the short-term interest rate, isn't it? Unlike in the olden days where the call money rate, as I said before, it used to peak sometime, maybe 75. I remember some cases where it used to go up to 100%. Now there is no reason why should the call money rate go beyond the 4%. Occasionally it does happen. I will show you that data as well, right? Sometimes it also crosses the floor. Sometimes it falls below the 3.35%, right? Though the Reserve Bank of India is offering you 3.35% overnight, fund parking with RBI, sometimes, you lend in the call money market, even below the reverse repo rate. It happens, and it did happen, right? It has been happening. Now let me bring in, the RBI's first step. I said some years before, right, Reserve Bank came out with the MSF, marginal standing facility, which is nothing but the penal interest rate, right? You can borrow at 4% only to the extent of 0.25% of your net demand and time liabilities. If I am a bank having 100 crore net demand and time liabilities, I can only borrow 25 lakh rupees from the Reserve Bank of India for overnight lending at 4%. So there is certain limitations, isn't it? Therefore, now Reserve Bank says that don't worry, if you need more funds in the short run, overnight funds, I can lend you, but at a penal interest rate. That is what is meant by marginal standing facility, which is 4.25%, right? Now, therefore, now I will introduce the extended corridor, right? I said you have the MSF and the ceiling of the corridor today, right? At 4.25%, you can borrow up to almost 0.75% of your net demand and time liabilities, right? And the Reserve Bank has introduced on 8th April, Reserve Bank announced the new floor, right? Making the original floor of the interest rate corridor redundant. Reserve Bank says, I am now giving you SDF, standing deposit facility. If you have surplus funds, you park with me, but it is unsecured in the sense Reserve Bank will not give you any government security as a pledge, right? So you can park your short-term funds with the Reserve Bank of India, at this SDF, standing deposit facility, which is 3.75%. Therefore, now you have a different corridor altogether. It is almost symmetric around the repo rate, right? You have MSF 4.25%, 25 basis point higher than the repo rate, and the floor of the corridor, which is defined by the new standing deposit facility, which is 3.75%, which in turn is 25 basis point below the repo rate. So it has become symmetric, and the tunnel has become slightly wider, right? Slightly wider, point number one. And point number two, the reverse repo rate has become redundant. So this is the tunnel now. This is what is the interest rate corridor as far as the Reserve Bank of India is concerned. Interest rate corridor, or otherwise you call it the LAF corridor, right? Liquidity adjustment facility corridor. This is what, I call it alternatively, the snake in the tunnel. The snake cannot, the red snake, the snake cannot breach the, corridor. Neither the upper ceiling, right? Neither the ceiling nor the floor. That snake will move within that corridor. This is what the new development introduced by the Reserve Bank of India by their bi-monthly monetary policy, which came out on 8th of April, right? Now I would raise a very important question before you, right? Like, is this enough to absorb liquidity, right? How Reserve Bank of India, did it do sufficient enough to control the liquidity, right? That point is I'm trying to very strongly flag before you, right? We will discuss that particular issue now. Are you with me so far? Am I making sense to all of you?
Yes, sir.
Yeah, you can go ahead. So it's
Oh, fine. I just borrowed this from the RBI's the latest monetary policy announcement, that document. I'm asking a very important question before you. Why does call money rate deviate from the LAC corridor? If Reserve Bank says that they have very effectively controlled the short-term interest rate, right? Particularly, in comparison to the rate prevailed in the call money rate, the interbank lending and borrowing market, right? This is what the LAF corridor. You look at it here, you can, see a very important point here. You see this line here, this the bottom line, which is reverse repo rate, right? I am not introducing the so-called standing deposit facility. You take reverse repo rate as the floor, right? And this black line here, this black line is MSF. That is the ceiling of the, ceiling of the corridor. The interest rate ideally, the short-run interest rate should ideally be within that band, within this corridor. It cannot go beyond the MSF, nor it can fall below the reverse repo rate, isn't it? But you can see the call money rate. I'm introducing a new variable here called weighted average call money rate. This is what is WACR. In the call money rate, in the call money market, the rate has actually fallen below the floor. How can this happen? Is it that Reserve Bank of India, have not or has not, observed this? They have observed this, isn't it? It essentially means that, there is too much liquidity in the short run, right? That means banks are even, able to lend at lower than the reverse repo rate. When the reverse repo rate is 3.35%, banks are lending, or many banks can even borrow at a lower rate. You can see the movement of this dotted line here, this red line. This is what is the weighted average call money rate. Weighted average call money rate essentially signifies the average of the rate prevailed in 4 metro cities. For example, Kolkata, Mumbai, Delhi, and Chennai. These 3 are the very prominent, strong call money markets, right? You take the rates prevailing in these 4 markets and you take the weighted average of that rate. That is what is called the weighted average call money rate. So the call money rate, the interbank lending and borrowing rate, has actually breached the interest rate corridor. That is what is the main point here. Why did it happen? That is an important point, right? This essentially signifies there is enormous amount of liquidity pent up with the banking system, right? They are, willing to lend at even a lower rate. This is what that essentially means. There is surplus liquidity. The government or the Reserve Bank of India has to be very conscious about this particular fact, that this surplus liquidity can actually trigger inflation, isn't it? This has to be absorbed by the Reserve Bank of India. That essentially means Reserve Bank, it is high time to actually revise the rate, isn't it? It has to go, it has to absorb that bitter pill. What is that bitter pill? Absorbing higher interest rate. it can cause your growth, right? The economy, GDP would be affected. That is the worry with the government as well, right? Government, lower and lower the interest rate, happier would be the government. But that may not go very well with the interest in the money market. You have studied ISLM model, I'm sure. What is the ISLM model talks about? In the IS market, IS is representing the real sector of the economy, our production sector. GDP is coming out from the real sector. Production takes place there. Investment and saving, etc., happening there, isn't it? So in the real sector, the lower the interest rate, higher and higher will be the output. You have a downward sloping IS function. This essentially means, lower the interest rate, better will be the output in the real sector of the economy. But you find just an opposite forces operating in the monetary sector, isn't it? Right? The LM function representing the monetary sector is upward sloping. What does that essentially mean? It means, the larger the output, higher and higher would be the interest rate, isn't it? Reserve Bank cannot, right? Reserve Bank you may not be happy with the low interest. Low interest rate will go always with the lower output. Higher interest rate will always go with the higher output, isn't it? Therefore, there has to be a kind of an amicable, kind of an equilibrium. If you put these two processes together, I mean these two lines, IS and LM, you will have an equilibrium interest rate and an equilibrium output, whereby you will have a kind of simultaneous equilibrium in the real sector as well as in the monetary sector. This is what you have studied in the ISLM model in the short run, isn't it? Precisely, I am talking about that, right? Precisely, this is what the issue. So, as I said before, as an introduction, one of the MPC members, I personally know him, Mridul Sagar. He made a statement that look, we have a very peculiar situation in our country, right? We cannot very quickly act. That could probably hamper the growth in our country because we have a flatter, Phillips curve. Short run Phillips curve you have studied. What does that actually mean? What does that signify? Short run Phillips curve say there is a trade-off in the short run. Trade-off between inflation and unemployment, right? If you don't want, if you cannot tolerate high inflation, you have to be happy with a lesser output and a larger unemployment, right? Isn't it? If you can absorb a higher inflation, your unemployment level will be lower and there will be larger output. So he says, now we should know how flatter is the Phillips curve is in India, right? When he says flatter, how flatter it is? If it is perfectly flat, corresponding to proportionate to the x-axis, then it is a different issue altogether, right? Maybe it is relatively flatter. That means slope is relatively lower, right? Instead of a vertical Phillips curve, you have a relatively flat or flatter, Phillips curve, right? Therefore, a small, reduction in inflation, right, would have a significant, impact on the unemployment situation in our country, right? This is what essentially the point. Right? Therefore, with this background, I should be able to, pinpoint that particular issue. I can show you one more very, much more clearer picture. The point which I was explaining to you is the call money rate and interest rate corridor. Going by what I have explained and by your own understanding, call money rate should be within the interest rate corridor. There is no reason why call money rate should go beyond or below the corridor. No reason, right? Call money rate should be defined by the width of the corridor. That is what Reserve Bank wanted. Therefore, you can see that the repo rate is becoming a benchmark short-term interest rate. That is not happening, unfortunately. You can see that the picture, right? I have taken the data from April 19, 2020 to almost, April 9, 2022, right? This is exactly the next day after the monetary policy announcement was made. You look at this corridor, where does the corridor and where does the call money rate lie? There is a huge difference. What does this essentially mean? I am sure Reserve Bank should be concerned about this. Reserve Bank should definitely act on this. This essentially means, the weighted call money rate. You can see this WCMR. This is what is this red line, very highly volatile. This is the interbank rate, right? Interbank borrowing and lending rate. That has become very highly volatile, point number one. Point number two, it has fallen below the reverse repo rate, right? Below the reverse repo rate. That essentially means you can look at particularly from September 2020 onwards. This has been continuously lying below the reverse repo rate. This is actually a concern, and there is an important underlying fact there, that there is too much liquidity in the marketplace. Banks are flooded with deposits. Banks have enormous amount of liquidity, isn't it? This can create trouble to the economy, not only in the short run. The short run inflation you are finding today, 6.1%, 5.7 to 6.1%. This actually triggering inflation in the future in the form of very high inflationary expectations. So inflation begets inflation in our country, isn't it? Unless government absorb this liquidity today, right? Looking at this particular thing that the Reserve Bank itself has drawn that. I am only just repeating. Reserve Bank has shown that. You look at this dotted line lying below the reverse repo rate, the floor of the corridor, isn't it? Right? From September 2020 onwards, the reverse repo rate has been higher than the interbank borrowing and lending rate, which is otherwise the weighted call money rate, right? It cannot happen just like that. Why? Because there is surplus liquidity here in the economy, in the marketplace. This actually is creating havoc with the economy. Too much liquidity, pushing the output, pushing the prices up, creating inflation, right? That can hamper, the growth and the standard of life of the people. All that stuff you would have already studied. I'm talking about the students, right? This is what the issue. So the question which I'm raising here is this, that I started with that particular question. The question is this: short-term liquidity and interest rate management is a revision of policy stance overview. How long, how far Reserve Bank of India will dance to the tune of the government of India? Let me put it, very frankly, isn't it? The time has come. Reserve Bank of India has to go for very tough policy options, right? Policy options for what? To absorb the surplus liquidity and control the inflation, right? Maintaining the inflation rate, at that 6% tolerance level is not good enough. That's giving a very wrong signals to the market, isn't it? Reserve Bank of India, when they started with the inflation targeting way back in 2016, gave a very firm commitment to all of us, to the business sector particularly, that we will contain inflation at 4 plus or minus 2, isn't it? So ideally, it should be tied somewhere around 4%. That is considered to be our tolerable level of inflation in the medium to long term. Even in the short term there can be fluctuations. That is why they came out with that fit, flexible inflation targeting, but it does not mean that, you tag the inflation rate always, at around 6%. That is going to give a very different perspective about the Reserve Bank of India, and also the credibility of the bank, Reserve Bank of India, will be questioned sooner or later. You understand this, you have to understand in the light of the tougher policy options taken by the Federal Reserve in the US, right? The tapering has started. They have found that the inflation rate is growing. Now the inflation rate has actually crossed the 40-year record. In the US, it has touched 8.7%. Now, they have no more, waiting time, right? Federal Reserve has immediately jumped into action and, increased the interest rate, right? They are now, managing the so-called balance sheet of the central bank in a very credible manner, right? Tapering is almost done with, right? Interest rate is going to go up, and Jay Powell has already announced that in the month of April, there will be another 50 basis point increase in the dollar interest rate. This gives a very clear signal to the whole world today why, fund houses are pulling out from Indian economy. Even today, the stock market has almost fallen by, the Nifty has fallen by almost 200 plus point. The reason being, foreign fund houses are pulling out of India. Why? Because interest rate in the US is going up, isn't it? Therefore, it is high time. If you don't act today in the right time now, there can be serious, medium to long-term repercussions in our country. Liquidity is going on. The foreign liquidity, the short-term funds which has come to our country, right? Markets, right? Giving liquidity in the stock market, money market, bond market, etc. They are all now, slowly withdrawing, isn't it? And the dollar has been strengthening against practically every other currency, right? And the European Central Bank also is, no different in terms of policy action. They have already increased the interest rate. So these are the signs. If you wanted to control inflation and preventing inflation begetting further higher inflation, you have to act right now, isn't it? No accommodating policy stance going to help us, right? The so-called accommodating stand that, there is a discussion now, debate globally today, right? But the nexus between central bank and the government, or the unholy alliance between the fiscal policy and monetary policy, right? That is not what we wanted, right? Reserve Bank has its very clear mandate as defined by the Reserve Bank of India Act 1934. It's a statutory body. There is no need to really, dance to the tune of the government. It will not work, right? So you cannot mortgage the kind of independence of the, monetary policy, isn't it? So I'm raising this particular, very important policy question before you, right? Is Reserve Bank of India buying time, right? Or the action is, late or not, right? The revision of the policy stance today, the so-called accommodative stance, that has to be revised. It is highly overdue today. This is what my point, and this is a very small issue. As I said before, I was just testing the water, right? Let me now stop sharing the PowerPoint. Let me just get some feedback from you, in the sense, some questions, so that I will be able to understand whether you have absorbed what I have discussed, right? Any questions, sir? The floor is open for you and your students. I will be happy if I could answer some questions. I will try.
Thank you, Sahadevan, for your excellent talk on such a difficult subject as monetary policy. You have, in fact, walked us through the nitty-gritty of monetary policy in the country. And you explained very clearly, in very simple terms, understandable to students, how the monetary policy currently pursued by the Reserve Bank has landed the country or landed the economy with excess liquidity, which will have harmful implications for the economy. You have even questioned, though in a very subtle language, the integrity of the institution of RBI in formulating the policy. And once again, I thank you and I request reaction from our students. Please. Students, please. Yes. First, your name.
Sir, my name is Anjana. My question is, you talked about how there is a problem of flattening Phillips curve in India. So is there any solution or any measures to solve this problem? And also I have one question. Is this problem or issue of flattening Phillips curve a result of the COVID-19 pandemic?
This is what I have even Mridul Sagar, when he raised this issue, I wondered on what basis he has been talking about the flatness of the Phillips curve. How flat is this flat? I was wondering. I have no data to substantiate his claim. He would have rather, told us this is what is the slope of the Phillips curve in India. Right? We all have studied a downward sloping, Phillips curve, right? We studied there is a trade-off between unemployment and the inflation rate. Lower the inflation rate, larger will be the unemployment, and vice versa, isn't it? But unless we know how flat is this, Phillips curve, maybe due to pandemic, you have rightly pointed it out, we have to have some empirical evidence on that, isn't it? Then only that can be converted into a suitable policy action, as Mridul himself mentioned it out, right? Therefore, I have no specific answer to your question, right? I won't be able to address that unless I have, some credential, data. How flat is this flat?
Could it be a temporary phenomenon? See, recently they talk about many new expressions like K-shaped K-shaped growth, S-shaped growth, and things like that. But these are all some fancy expressions which will explain a very short period phenomenon. Probably this could be one of those where the rate of interest, sorry, the inflation rate doesn't have any impact on unemployment. Whatever be the inflation rate, unemployment is there. Could be that.
Yeah.
Is it? I'm not sure because I'm not.
I think student, you should take up this particular issue and ponder over this collectively. What does this actually mean? I would also advise you to read that policy document. There was a mention about this thing in the document. You carefully go through that, right? Probably we can discuss that sometime later as well. This itself can be a topic, the Phillips curve in the Indian context. This is a very important, macroeconomic issue in our country, right? Do we have really a trade-off? Or Reserve Bank does that feel that, interest rate has not much relevance in our country? That is also, we don't have adequate credential, empirical evidence. Does our investment, determine, or the interest rate determine the investment to what extent? What is the evidence? Yes, sir, back to you.
Any other question?
So the Yeah. Is it that the topic did not go down that well with the students?
No, another person is asking question. Yeah. First, your name, please. Yeah.
Good evening, sir.
Good evening.
My name is Arshad. So my question is, that is the country belongs to BRICS have decided to reduce the US Treasury holdings. So what are the consequences of that decision?
Yeah, that is an important issue, but of course, not directly related to the topic we are discussing, but it's an interesting question. This is expected to happen. We ultimately what we needed is a multipolar, currency system in the world. Why should always you hold dollar denominated assets? Right? We needed to have a portfolio of foreign exchange assets. Dollar can be one, it can be euro, it should be gold, or it can be yen. Why not euro? There are many currencies, isn't it? But over a period of time, this dollar ascendancy in the world has actually gone up, leading to a unipolar world currency system, isn't it? It's a good development. That is now going to be expedited. This kind of a diversification of international portfolio of foreign exchange reserve going to go up, particularly in the context of this Russian embargo or the restrictions on Russian transactions. The US government has imposed a lot of restrictions for, therefore eventually what happened, whatever be the dollar assets Russia holding, it has no relevance, isn't it? What do they do with so much of dollar holding, isn't it? This actually has boomeranged the US economy. Therefore there is a growing feeling among other countries that in future holding dollar reserve alone can actually pose problems to many countries. Therefore, this is a first step towards that kind of development of a multipolar currency system in the world. You should appreciate it and we should welcome it, isn't it? Yeah.
Any other question?
Thank you, sir.
Thank you.
Sir, can I?
Yeah.
Yes, please.
Good evening, sir. I'm Siddharth R. I'm from Department of Economics, University of Kerala. So my question is, given the high unemployment rate and also the very high inflation rate that is going on now, how do you think you actually think that we have to prioritize inflation right now because it is going in a too steeper way? But in a general way, do you think the central bank should be prioritizing unemployment or inflation? It is true that we are going for an inflation targeting regime, but when we design the RBI's loss functions, the two main factors for the loss function are unemployment and inflation. So in general, in the context of India, do you think the RBI should be unemployment averse or inflation averse?
Let me, before addressing your question, Dr. Siddharth, let us resolve among ourselves that supply side options are very limited today, right? All of a sudden, we cannot increase supply to fight inflation. That would have been an ideal solution. We all have studied. Why do you approach the inflation through the demand side? Very unreasonable. Don't curb demand. That can actually, cause a lot of other problems in the future. So in an ideal situation, we should actually increase GDP, but we are not able to do that. Understand this situation now. There is no other way than Reserve Bank of India, sucking the liquidity, surplus money, surplus purchasing power in the economy and control inflation, right? That realization is very, very important now. There are supply side global supply chain disruptions, And within the economy also, there are supply side problems, right? Because investment is not coming up in spite of all these production linked incentives and various other fiscal policy incentives. Private investment is actually not picking up in a significant manner in our country. This is a growing concern. So we don't know, this is with a concern. We don't know when the supply is going to happen, right? Now look at the latest update from the IMF. They have already came out with a downward revision of our targeted growth from 8.75% to 8%. These are all giving very subtle kind of an information to all of us that there is not going to be a very significant improvement in terms of supply. Therefore, Reserve Bank should be all the more alert with regard to inflation. It can only be done through the demand side. Reserve Bank has to curb demand. Reserve Bank has to absorb the surplus liquidity in the economy. That is the only way out. Point number 2, the related point, directly related point with your question is this, that we still do not know the sensitivity of unemployment with respect to inflation. Essentially speaking, the flatness or steepness of the Phillips curve. How do we know? We don't have the adequate data now, isn't it? Unless you know that, how do we act? Right? Siddharth,
Yes,
did
sir.
I
I
answer your
totally.
question?
Yes, sir, you did.
Yeah.
Sir, and like I totally agree with you on the supply side inadequacy of the inflation targeting regime. So, do you think it's high time for the Reserve Bank to consider other mechanisms like the nominal GDP targeting to counter the inflation targeting regime? Because the 2008 financial recession actually showed the demerits of inflation targeting, and it showed how inflation targeting creates asset bubbles and also fails to counter supply side shocks. And the pandemic is also another reflection on that. So I'm not saying we should adopt nominal GDP targeting because it's never been tested and proven, but shouldn't we consider nominal GDP targeting more seriously, and shouldn't we study on the area and mechanism more?
Very true. I have no other point to add yours. This has been I remember in one of the issues of the Economist magazine, I think last year. This was the issue, not only in the Indian context, but globally. Should we actually target nominal GDP growth in the light of the very high inflation prevailing? Yes, this is the high time we should, think about, instead of targeting the real growth, we should target the nominal growth.
Thank you, sir.
Yeah. Yes, any other questions? I would appreciate students asking some questions.
Yeah, they are.
My name is Anaka, and my question is, what are the challenges before the Monetary Policy Committee when inflation increases beyond the central bank's comfort zone?
It is a big challenge. Of course, they cannot afford that. How are they really waiting so far? This is what the question I have raised before you. How can Reserve Bank of India wait for long to control inflation? Because their own credibility is being questioned now, isn't it? Sooner or later, people will not care. When they gave a very firm commitment in 2016, the business sector accepted that because it's coming from a very creditworthy, credible institution. They are ensuring us that inflation will not go beyond at any cost 6%. Now we have crossed that. Now it is up to the Reserve Bank of India. Do you want credibility, or you want to go by what the government or political circle wanted? This is the big question, right? I am strongly agreeing. I am a very strong point regarding this RBI stance of late. This has never happened in the history of our country. We have in general been talking about quality of institutions have been surrendered and things like that. Yes, you are seeing in your own eyes. Never the credibility of economic institution being questioned, this scale earlier, isn't it? What are they up to? I mean, what are they waiting for now? They should control. It's affecting, crores of, Indian people. Their, standard of life, standard of living, everything being affected. Inflation rate is, see, look at the phenomenon today. Everybody knows. I mean, within the Reserve Bank of India and the government as well, the wholesale price inflation is almost 14%, right? And the retail inflation is just not even half of that, right? Any common man can understand that the inflation rate, even if the CPI based inflation is lower, with a lag, it will catch up with the wholesale price inflation, isn't it? Right? The CPI inflation also will go up along with the WPI inflation. It's only a matter of time, right? Is that it is not known to Reserve Bank of India? Is it that it is not known to the government of India? They all know about it, isn't it? But why then this wait and watch policy now? You have waited and watched for so long. Now you have to act, isn't it? We all expected. I mean, the market expectation was not really, accommodating stance anymore. We have to very firmly intervene and control inflation, increase the repo, reverse repo, and across the board industry. Then only the issue can be addressed now. Otherwise, it can affect. You understand, student. Short-term interest rate will have long-term impact. Today, if the interest rate is low, investment will not take place. At least, there is some correlation between interest rate and the investment, isn't it? Let us not assume that there is complete 100% correlation. Assume that there is a 60% correlation. That means the short-run interest rate today is going to affect the investment today, which is going to affect your output in the future. That means this scenario today is going to have impact in the medium to long term as well, unless Reserve Bank of India puts its acts together in a meaningful manner. This is what my main point was, right? I'm happy that you reminded me to reiterate that particular point.
Thank you, sir.
Any next question? There is any other question, please?
Hello, sir.
Yes.
Yes.
Sir, my name is Manu. My question is, when the RBI is going to introduce the central bank digital currency in coming days, so will it influence the inflation of our country?
I think your audio is not very clear to me.
Hello, sir. Am I audible?
Yeah, please continue.
Okay. RBI is going to introduce the digital currency in recent times. So will it influence the inflation of our country?
First part I did not get. It's not coming correctly.
Are you talking
The
about
voice is broken.
Digital currency.
Digital currency, yeah. His question is on digital currency and its likely impact on inflation, isn't it?
Okay, digital currency. Yes. No, digital currency, anyway, we have not accepted the virtual currency, particularly Bitcoin, isn't it? Unless it is, legal tender currency. I don't think you can take that as a, standard asset class. What is the problem in it? As long as it is not a legal tender currency, it's not going to hamper the, monetary policy engagement of the Reserve Bank of India, right?
So I'm speaking about central bank digital currency. Central bank digital currency.
Central bank digital currency. Yes, that is, I mean, it is non-consequential. As far as I'm concerned, if central bank is coming out with a digital currency, there is accountability, there is ownership, right? It is the liability of the Reserve Bank of India. There is complete accountability as well. Unlike the digital currency where the source is not known, the owner is not known, and the volume and quantity is not known, that can actually create a lot of havoc with the monetary, policy or the monetary equilibrium of the country, isn't it? But if the central bank is coming out with a digital currency, there is perfect, accountability to that. How much currency is issued, right? So therefore, it does not actually conflict with our monetary interest in our country. This is what my view. I mean, it is actually, yes. Why should we worried about that? China, in order to, counter the growing interest in the Bitcoin, they have immediately come out with the digital currency, right? They know exactly how much has been issued. So therefore, control is lying with the Central Bank of India. As long as that happens, I don't think there is any need for worry as far as digital currency by the central bank is concerned.
Okay, sir. Thank you.
Okay. Any other question?
Sir, we can close if there are no questions.
Yeah, let us see if there is.
Yeah.
Sir, shall I ask one?
Yeah, please.
Please.
So first of all, we know that the retail inflation rate is increasing and it is around 6.5%. But the savings bank rate is much lower than that, which means that the real rate of interest available to the households or the common man is in the negative territory. In that situation, the conventional wisdom says that the central bank of that country must increase the nominal rates to such a level where it gives some reasonable returns to the households or the people who save. But that is actually not taking place. We know that on the other side, the capacity utilization rate of the Indian industry is not came back to the pre-pandemic level. So there are issues in the manufacturing sector also. And also the US interest rate is also increasing. So this is the macroeconomic outlook that we have. In this situation, what do you think, or what would be your comment regarding the stance of the Reserve Bank in this situation? And the second question is that we have a divergence between the retail inflation rate and the wholesale inflation rate. And this divergence is not a new thing. For the last 8 or 10 months, we are seeing this divergence. The WPI inflation is at more than 10% level, while the retail inflation is below 10%. It's even though it is increasing. Then what would be the precise reason for having such a divergence for a fairly long period of time?
Yeah, let me take up the first question. You have already given the answer as well. This can only be a short-term aberration as far as I am concerned, because the real interest rate, real return on any financial asset cannot be in the sub-zero region. That is an abnormal situation, right? That can actually distort the household saving, which can be very harmful and disastrous for a country like India. I started feeling, you also started feeling that why should I put my money in the commercial bank? When the inflation rate is almost 7%, you are getting 5.1% on your 1-year deposit, right? Isn't it? So therefore, this cannot be a long-term sustainable phenomenon. This is only absolutely a short-term aberration, economic aberration. This cannot happen, right? Therefore, it is all the more reason why Reserve Bank of India should act immediately, isn't it? Otherwise, this can harm our country in terms of substantial reduction in the household savings, right? You understand the consequence. Now the households are the main, financiers of investment in our country. You know about the data as well. Almost 60% of our, investment is financed by the household savings. If they don't save now, assuming that, what I am getting from the bank, right? If we all don't save, who is going to finance the investment in our country? This is going to be detrimental for a country like India in the medium to long term. Therefore, it is yet another important reason why we should, Reserve Bank of India should act without any delay, right? You rightly pointed out it has been there almost for, almost close to 2 years now, right? And point number 2, what you have explained in terms of what was the second question?
So the divergence between the wholesale.
Divergence. I also said it. I mean, I have observed, I have been talking to my students as well. Look at the growing phenomenon and divergence between the CPI and WPI, right? Though we cannot make an absolute statement that, this divergence will be bridged in a due course of time, because these two baskets are two different baskets, right? The components of the WPI basket is different from that of the CPI. But nevertheless, it is going to happen within a short period of time, with a time lag. I don't know how short is that short or how long is that long period. I mean, within some period of time, maybe 1 year or 2 year, 2.5 year period, both will converge, right? I'm sure there is enough indications that CPI will move towards the WPI with a lag. How long is that lag is the only question, right? Therefore, Reserve Bank cannot wait anymore. Let us make this very upfront statement that it is high time. Reserve Bank put its acts together and fight inflation today. They should learn from the Federal Reserve. They should learn from the the European Central Bank. Right? Japan can afford it. Japan is a different story altogether. Or maybe to certain extent, Turkey also can afford, but not India. Because we have problem already with the distribution of income. We have a lower income people, large in number. They are very seriously affected, which is a concern, right? Yes, sir.
The divergence between the two, can it be partially explained away by the fact that it's a core inflation that gets reflected in wholesale price movement, and the headline inflation gets reflected in the WPI? Could it be one of the reasons? Because these days we have seen that the prices of the core things have been going up, whereas commodity prices have remained more or less constant.
Yeah, I appreciate that point. I think there is a point, yes. If you compare between the core inflation and the headline inflation, yes.
I think we can have one more question and conclude. What do you think?
I'm all right with that, sir. I'm available. It's already 5:45.
Yeah.
So I have one more sitting, one more meeting. In fact,
okay, then.
Yeah.
Then let us conclude. And I must thank Sahadevan once again for your very brilliant presentation of the monetary policy of Reserve Bank of India. And you have very clearly pointed out the pitfalls and explained every concept very clearly, so that I'm sure our students would have followed it very well. Thank you, Sahadevan, once again.
Thank you, sir. My greatest pleasure, sir. That too from my own, guru, right? I worked with you and you have been my teacher. Not only then, he continues to be my teacher, right? So thank you very much. I treat it as a big honor to me, right? I am anytime available. We can have interactions later as well. I would, my sincere thanks and acknowledgement to all your team members, particularly the students, Dr. Hedumar, and many others, right? Thank you very much for giving this great opportunity to interact with my people in my alma mater. Thank you, sir.
And Santosh Varghese, who asked the last question.